Well, hello, everyone. It is 1:30 on the West Coast, which it means it's time for us to get started. I am Erich Patten. I'm the Chief Investment Officer at Cutler, and I'm joined with Bryan Knutson. Bryan is in our Seattle office and a Senior Wealth Management Advisor. And we're here today to talk about a wrap-up of the previous year and an outlook for 2023. So with that, let me share my screen again, and we can get started. All right, we've titled today's presentation, a light at the end of the tunnel with a question mark. And hold on, let me just make sure we're doing a slideshow here. All right. Oh, resume slideshow. There we go. Oh, and really, there's a lot of reasons to be optimistic. We've had a very negative environment, and we're going to recap that and really talk about what happened in 2022. But as we sit here today, as of Friday, the S&P was up 4.2% on the year. The NASDAQ recently had a run of consecutive positive days that it hasn't had in 2 years. International developed markets are up 7%, emerging markets are up 7.7%, and even aggregate bonds are up 2.7%. It's been a great start to 2023. And really the question for us is, will that continue? What can we expect as 2023 begins to unfold? And we're going to talk quite a bit about that and walk you through some of the fundamentals in our economy and what Cutler is looking at, how we'd be positioning portfolios. As always, let's start with our disclosure presentation. And we have, in a couple of slides, we're going to show you really everything that happened in 2022. And a lot happens as the year moves on. We're going to adjust our views accordingly. But this presentation is really a consolidation of the best information we have available today. As new information becomes available, we will be adjusting our views accordingly. All right, so today's agenda is a review of the fourth quarter, and again, our recommended portfolio positioning. And then we're going to walk through current market events and really talk about three salient points here. When will inflation get down to Fed targets? Will consumer strength prevent a hard landing? And really the question that everybody asks, not just at the beginning of the year, but throughout the year, will stocks and bonds rally in 2023? But Bryan, why don't you take it from here and talk about really what happened in the fourth quarter? Did we get that Santa Claus rally that everybody looks forward to at the end of the year?
Well, we got a rally. Whether it was a Santa Claus rally depends on how many gifts you would expect to get from Santa Claus, I suppose. But we did come off of the lows. So the year 2022 was unusual in that it was pretty notably negative for both stocks and bonds. In years in the past, we would be used to seeing more of a seesaw motion. If one was down, the other tended to be kind of flat to up. That didn't happen. We're going to talk about why as we go forward. But the good news for the fourth quarter in particular was we did see upside in the classes that are listed here. In bonds, what did we see? We saw the worst year for aggregate bonds in history. Okay, we're going to talk later about specifics on how that happened. But the good news in the fourth quarter was we did see a rally. It was a pretty good size rally, about 2% for taxable bonds. Stocks, and in this, I will say, measured by the S&P 500 for that second bullet, domestic stocks had a really good fourth quarter. The low point for the year, and hopefully for good, was somewhere around the end of October. Okay, what happened after that? Started to see some light at the end of the tunnel, as we said in the title, that we might be closer to the end of rate increases than the beginning. I would certainly say no matter where we end, that's true. Foreign stocks were helped by multiple factors, some relief in China, some relief of maybe some easing in Russia, Ukraine, some relief in the need for energy with a pretty mild winter, and relief in the dollar dragging returns in other markets. We'll talk again more about that later, but that helped those areas a lot. They had better returns than we did. Developed markets in particular had a fantastic last quarter to close out a still a pretty rough year, but at least that's a good sign for going forward. Alternatives had a great year in aggregate, especially because they were down less than both stocks and bonds. They were a nice third leg of the stool. We still like that positioning for going forward as a diversifier as volatility still tries to work itself out.
Yeah, thanks, Bryan. When I look at these asset classes, I see some very strong trends from 2022, and I'm going to just kind of beat ourselves to the punch here and give you the punchline of what we think. We think that some of the trends from last year should continue into the current year. And we don't mean in terms of absolute return, because these asset classes, for the most part, had very negative returns. But we mean in terms of the relative strength. So I underlined a few items here on this page. Short bonds, we would still maintain shorter bond portfolios. We think there's some great opportunities at the short end of the yield curve. We'll talk about that. And then value continues to value widely outpaced growth last year. We still see that trend continuing this year. And as we move on to our quilt chart here on the next page, I'm just going to highlight one year that really stands out to me, which is 2016. Large cap value, you may be able to, it depends on how big your screen is here, but I'll walk you through it. In 2016, you can see large cap value had a 17% return and large cap growth had a 7% return. For the most part, growth has outperformed value over the course of this chart. But in 2016, that was an exception. And in 2022, that was an exception. You can also see in 2022, a minus 7% versus a minus 29% for large cap growth. Bryan, what happened in 2016? Is that kind of a dynamic that we could see continuing into this year?
I would say we can. And so let's put on our history hats and remember that in 2016, we were coming off of a period of multiple years where rates were at or near zero. Sound familiar? It's just like what we were in before this last year. And what happened in 2016, we had a very long measured series of rate increases, a quarter point, et cetera. So we got from 0 to 2.5. We got 10 total rate rises. If you count each 1/4 point as one rate rise, we got 10 of them, but it happened over 3 calendar years. In this most recent year, we got 17 of them over the course of 9 months. A much different dynamic. In 2016, though, why did value outpace growth? Why did shorter bonds do well there? Because in those rising rate environments, first, I don't have to reach for yield. I don't have to go out 10 or 20 years. We're going to show you some stats on that. And value stocks can outperform there for several reasons. First, because they have nice free cash flows. Second, because growth stocks, they're not creating as much recurring cash. They are giving people the idea that they're going to be worth more in the future because they'll be able to sustain the growth needed to get to the valuations that people have placed on them. Well, that's a lot harder to do when your borrowing costs go up and when your kind of hurdles to reach those levels get harder, they get higher. Just like in 2022, all the classes being down, a little different dynamic than 16 because the rapidity, the rapid pace of those rate rises, and because of where we ended. But still in this environment, short bonds and value stocks are beating handily their counterparts, long bonds or growth stocks, for those reasons.
Yeah, and I think part of that theme on why we might continue to see relative strength is our view on the really the pace of the Fed and the direction of the Fed. And the market is forecasting a pivot this year, and actually a very significant pivot by the Fed. We'll talk about those reasons why, but in Cutler's view, we think the Fed is going to move more slowly than the market is forecasting, in which case we'll see some of these asset classes that benefit from that Fed action really having relative strength. Over the last year, there was really a lot of reasons to sell stocks. And this chart shows really everything that might have happened in the last year. But one thing that jumps out to us as investors is that every year has significant reasons to sell stocks. It's not just unique to 2022, but really if you look at the news flow and you just think of the upcoming this year, there's a lot of talk of a recession. We'll talk about that in several slides. There's a lot of talk about a debt ceiling debate. We're not going to talk about the debt ceiling debate on this call because we will get an opportunity at the next webinar before the government really is forced to make some decisions about the debt ceiling. But we've titled this chart "Waiting for Things to Calm Down is a Long Wait," and stocks often turn before the economy does. So we advocate maintaining discipline, sticking with your investment allocation or your investment themes, and really not trying to time the market, because there are always reasons to sell when it comes to stocks. All right, so let's talk about inflation. This is the big question for investors this year. When will inflation get down to Fed targets? And the answer to that question is really going to dictate a lot in terms of the direction of stocks, because stocks have been reacting very significantly to Fed actions and really to Fed forecasts. So Bryan, let's take a look at what happened in inflation over the last year to 2 years, and where do we sit now?
Okay, so I will start with the chart on the right, and this is encouraging, but still a note of measured caution. What we see here is the year over year. So this is comparing, say, this June to last June, December to December, right? This is not changes by month, this is changes by year. In June of 21, we crossed over 5% for the headline CPI. So that would be Consumer Price Index that does include food and energy. The core one does not. This one does. We reached a level where we were in the low to mid fives for about 4 straight months. Okay, what happened next? It jumped. It jumped again and it jumped again. As that pink turns into more of a red, those numbers are getting higher. We peaked, and I do believe, even as a bit of an inflation hawk, I think we did peak in June of 22 at 9.1. Okay, what's happened since then? We have started to see that trend come down for several reasons. First, when prices, get high enough, it's hard to continue to compound prices increasing at those levels. And the Fed, belatedly, but they are getting the action that they need out of the rate increases. The concern would be, the caution would be that we are still at 6.5, 6.45. You can see down at the bottom, we are roughly the same as we were somewhere between October and November of 21. So this really does look like almost a classic inverted triangle, but the number is improving. It is still too high, but it is improving. Where is it coming from? Look at the left. This is a change year over year again of some major categories. All right, the good news is several of those categories are negative. If you go down to the bottom, gasoline, of course, gets a lot of attention. Consumer sentiment is very closely tied to gasoline, including mine. I really don't like to overpay. But what we can see near the lower middle is overall CPI at plus 6.5. The good news is that is lower than it was before. But what we need to look at is what factors are still driving some of those increases. As anyone who's read the commentary already would know, we did mention services having sort of taken the baton from goods and driving forward some of the increases that we've seen. But in the near term, I can see that there are some categories here that have gotten better. There are some that still have some work to do. And as those change over time, that's going to be a big driver. One note I'll close with is shelter, listed on here at plus 7.5, is a very large component that will, like gasoline gets the near-term attention, shelter will get the long-term attention. We'll need to see where that changes over time.
Yeah, and Bryan, you mentioned gasoline. I think that's really what got everybody's attention last year. What's getting everybody's attention on an inflation front right now is food. And we've heard stories of egg prices really going through the roof, and there's just a lot of work still to be done by the Fed to get this inflation picture under control. But we're in a much better position today than we were a year ago. And let's look at really the growth of money. And Milton Friedman said that inflation is a monetary phenomenon. And this chart really shows that in a concrete way. You can see two major outliers on this chart. This is the growth of the US money supply, not just hard cash, but also deposits and investments. And you can see in 2020, and we all lived through this and we know the reasons why, but M2 changed by 25%. That's just a phenomenal growth in the money supply. But then fast forward 2 years, the Fed is actively shrinking the money supply in our economy. And in fact, last year was the only negative year that we see on this chart. So we're making up for mistakes. There's still work to do, but the Fed is being very aggressive in correcting the past errors that have led us to the current situation. So wage inflation is really the last key component, and the Fed can control a lot of things in the economy. It's really hard to control wage inflation. Bryan, what's happening with wage inflation, and are we still anticipating that continuing into 2023?
So what has happened over the last several years is that there's been this massive influx, of cash. We saw that on the previous page. That has gone to people, that has gone to businesses. In the business case, what they can do then is use that to try to attract and retain talent. On the left-hand side here, what you see is there's three different lines, and they are kind of a broad strata of wage levels. And what we've seen, especially on the lower end of the wage scale, like for example, if you drive by a McDonald's in different cities, I've seen where they'll post their starting wage, right? There's a battle, there's a war for talent out there, and that's from the highest levels of pay to the lower levels of pay. What we saw was a big rise up in the lower end of wage. That's that green line, a spike up, drop back down, another spike back up again. That has pushed a lot of activity to people that maybe it's not bad to have more cash, but it does create some inflationary pressures because you then can use that cash and are more willing and able to absorb price increases. Where was a lot of this coming from? On the right-hand side, you can see the job movement, right? There was a lot of job bouncing in 21 and 22 as restrictions were relaxed and people got out and did what they wanted to do again. There was again that war for talent. So what we see there was an incentive to move jobs. You were getting a lot of hopping around. You also got some people that maybe stepped away from the workforce, thought they were done, got an attractive offer and went out and took it again. That displacement between movers and stayers is starting to shrink. You can see on the left side, those numbers are starting to trend down, most especially on the lower end, right? So you're not necessarily getting the people going from $15 an hour to 18 or 20, which would be a huge increase in their relative number. That is starting to come down. Layoff numbers are starting to come down. We do need this wage pressure to subside in order to get any sort of stability on the inflation side.
Yeah, it really does look like a lot of pent up demand for changing jobs coming out of the pandemic that led to a lot of this wage inflation. Wage inflation is actually good for consumers because they're making more money. It does create inflation pressure that the Fed is looking to alleviate, but ultimately Americans making more money is something that we want in an economy. We just want it in kind of more of a methodical way that won't create so many distortions in our prices through inflation. But let's transition there to consumers because wages are very closely related to consumer strength. And we talk a lot about consumers as the largest component of our GDP, of our growth comes from consumer spending. And will consumer strength in 2023 prevent a hard landing? When we say hard landing, what we're really referring to is how deep the recession that we're anticipating will be. Is the Fed able to navigate a soft landing, which is a metaphor about landing an airplane? Will they be able to land the economy from this rapid change in a way that doesn't create too much harm? Let's talk about the consumer. Bryan, savings rates are down. People aren't saving as much. Credit usage is up. They're spending on their credit cards more. Is that a good thing or is that a bad thing? Or what does that mean for our economy?
Well, it's a good thing for those companies where that activity is being utilized, but it's something to be cautious about for the consumers at large. But let's look at each of these individually. On the top half there, what we see is going back, and this goes back to 2008, but during most of that time, a typical savings rate for an American household was about 5%. If you made $50,000 for your cumulative household, you would retain in a savings account and or investments, whatever type, about $2,500 of that. Okay, if that was sustainable over time, you would be able to create a nice backstop that you could use for emergencies. What do we see in 2020? For a reduction in available activity for sure, some distributions of one or multiple checks to different households, a huge increase, right? It spiked up, and for those who can see that number, almost 34%. There is no way that it is sustainable for anyone to be able to save on an ongoing recurring basis 1/3 of their earnings unless you really have almost no expenses beyond, very specific ones. That did not last. We got another stimulus check that started to come down, a third that started to come down. We were still above trend, but there was just no way for that to be sustainable. What have we seen since then? A drop back down to about a typical level, but then now a drop below that level. That would be some combination of just pent up demand for things like travel, et cetera, that just wasn't available for people to do for a while, and increased prices. Okay, if I've reduced my savings rate, where am I getting access from? Go down below, and we can see the use of consumer credit. There have been periods in the past where it has dropped down. That would be in periods where folks either could not or did not feel like they were able to just financially use some of this available credit. You can see like in 2009, you can see it in 2020. Okay, what have we seen since then? An increase there. The good news about the bottom one is that has not exceeded so far recent history. It's gotten about to higher levels of recent history. The concern on that part would be just that the interest rates are higher, but that's going to be an individual case for individual people about what sort of credit they're using. If that continues to trend up, that would be an area of caution. But so far, it has just gotten back to historically reasonable levels.
Well, historically American levels, you might say, because
American
U.S.
levels,
consumers
yes, reasonable
do like to spend money, and we do like to use our credit cards. What's important to note, though, is that consumers are not stretched at this point in time, and we've shown this chart in many webinars in the past. This is a nice chart that JP Morgan produces on a quarterly basis, and it shows the consumer balance sheet on the left side here. And Bryan, you've said in the past that if this were a wealth management client, if it was an individual walking in who had this ratio of assets to liabilities, you would say you're in pretty good shape. Is that still the case? Do we still say that the U.S. balance sheet is in pretty good shape?
I would say the balance sheet is still in good shape. So the left-hand side there, it's got that stack of different types of investments. For those who have heard us say this in previous webinars, let's say like 2 quarters ago, for example, the ratio of assets to liabilities at that point was about 9-to-1. Now it is closer to about 8-to-1, just about over 160 to about 20 for assets to liabilities. That is still very good. That is solid footing. One reason why it's come down is, of course, the drop in invested asset prices and some softening in home prices. But that ratio is still incredibly strong. And the diversity of where the assets are held, the different types, is still broad enough that there isn't a concern about being overly focused on one area or another. So left-hand side, still feeling good. Also, mortgages, 2/3 of that liability in mortgages. We're going to have a bit more detail about that, but our mortgage situation here in America looks solid. On the right-hand side, the upper right, that ratio, once again, just like on the previous page, it is still containable. You can see we're nowhere near where we were in 2007. That was truly a debt-driven issue. This one is really just going to be, liquidity, and we're trying to constrict liquidity. There was too much. Now we're trying to kind of rein it in. Okay, if that ratio line keeps trending up, then we want to be, aware of who are our culprits there, and what is their ability to be able to pay that level down. On the bottom right, same idea as before, except this one has a trend line. If you look at that dotted line, there is our historical trend. You can see we've crossed under. We're kind of at to under. Yes, we know that from looking on the previous. However, this chart would indicate this is making a bit of a projection forward on where it might continue to trend down. You can see it sort of straightens out. We would like that to be the case. If that happens, and then we're able to rally back up out of that with hopefully some price alleviations, great. If that continues to be a bit more negative, then we have to just be aware that that could impact the ability, purchasing power, not pricing power so much, purchasing power. That is still very important in our economy.
Yeah, in a couple slides, we're going to talk about the likelihood of a recession and the possibility that we have a recession this year. And Bryan and I are going to tell you that we think it's going to be a shallow recession. When we're there, I want you to think back on this chart. Look at the debt service ratio of American consumers right now relative to the excesses we've had in the past, especially in 2007. When we talk about valuations of stocks, You think about the depth of the recession in 2000, that was a valuation-driven recession. Right now, both of those scenarios look fairly attractive, and that's a big part of why we think a recession won't be deep, that we can weather a shallow recession. It'll be a normal recession, which almost seems like an anomaly to a lot of us who have been investing in the markets for the last couple of decades. But yeah, I think this is a big component of why the U.S. economy is in good shape and why we should get through any slowdown without too much economic pain. Let's also talk about mortgage rates. We saw on the previous slide, I'll show you here again, 66% of our liabilities are mortgages. The vast majority of U.S. mortgage debt or U.S. debt is mortgage debt. And we saw a spike in interest rates this year. You can see it was 2.65 a couple of years ago, spiked up to 7%. It has then come off. We have 6.42 here on this chart, but it's really gotten closer to 6% even now. That hasn't affected American finances or American consumers' finances. What that has really affected is the housing market and the price that people can pay for new homes. But when you think of the existing consumers, you look on the right-hand side of this page, U.S. mortgage debt is almost entirely a fixed rate. Most Americans in this period of ultra low interest rates took out a 30-year fixed and they kind of fixed their mortgage and they didn't look back. Look around the globe, that's not always the case. Look at the UK, for example, where a fixed rate mortgage doesn't even really exist. In the UK, almost every mortgage is variable rate. That creates a huge amount of a headwind for consumers as their debt service costs continue to rise. In the US, that has not been the case, and debt service costs aren't nearly impacted by this rise in rates as they are elsewhere in the globe. All right, I mentioned we were going to talk about some of those recession indicators. Bryan, this is my least favorite slide in our presentation today. Can you tell us why that might be, and what as consumers or what as investors that might mean?
Sure. Okay. So I will just tell you right up front, these two indicators would say recession, yes. They're not entirely always accurate in that forecasting, but they are pretty good at it. So on the left-hand side, this is our inverted yield curve. Some of you may have heard that term, read that term. What does that mean? It means that the yield I get from a 6-month treasury, a 1-year treasury, a 2-year treasury is higher than the effective yield I get for a 10, a 20, a 30-year. I should get paid more for being willing to hold a bond for longer. That is the way that you would typically see it in a traditional yield curve. In this case, it's turned the other way. And as you can see, the times when that has happened, those areas in that light gray shading, those are areas where recession has happened. If you go way back to the 60s, I could find you a ray of hope to say that it has inverted without officially a recession being called, but almost always this does lead to something. The next part of that, though, would be how deep and how long. It does not appear that it would be that deep or that long. On the right-hand side, this is leading economic indicators, LEIs. This would be things like manufacturing numbers. This would be surveys of CEOs, things like that. And once again, in past periods where you did get multiple months. So the line, as the blue goes up, that is the number of consecutive months where those are showing reductions, reductions in good news, unfortunately. But right now, where are we at? About 9 months. You can forward that. And yes, we are now at about 10 months. Okay. But what the hope for this one would be that it's more like, if you look at 1990 to 92, once again, if you get into this deep, you'll read many comparisons between the situation now to what we were seeing then. Good consumer balance sheets, but still some softening in economic numbers, mostly because we had to, because we were running too hot. Okay, that number is very similar. Sorry, the length of increases, if you draw a line and go across, they're really similar. Okay, and I'll close on this one by saying some industries would already say, if you ask them, are you in a recession? They would already say yes. Manufacturing, that's not a huge part of the US economy, but it does still exist. Yes, that is already in those kind of areas. Housing, yes, it has already seen softening to that level. We are, though, very consumer driven. That would be that next leg, and that will have a big driver on whether in determining if this will be shallow and short, which we do think it will be.
Yeah, and the question we're hearing a lot from clients in this environment is, with a recession coming, why would I buy stocks? And I think that's an important question. That's really the question that investors, should be asking themselves. Our answer to that is the stock market is a leading indicator of economic growth. We saw stocks have a significant decline last year. Bryan, what was the S&P minus 19%?
About minus 19.
Yeah. So with the stock market down 19%, 2/3 of the time, stocks have a positive year or positive return after a negative year. So the stock market is pricing in a lot of this economic news before really investors even react to it. And so our view is to maintain that discipline and maintain that stock exposure, because stocks often turn about 6 months before economic growth begins to turn positive. Our view, will stocks and bonds rally in 2023, is yes, we believe both should have positive returns this year. And we'll talk a little bit why in this last section of our presentation. But let's start off with valuations. Valuations is a good news story for investors right now. Bryan, where do we sit with valuations in the stock market?
Okay, so another chart that folks are used to seeing, and this is a great way to sort of lay the table for where we stand on the left-hand side there. What do we see in 2022? We started the year very overvalued, right? It's easy to say that in retrospect, but it was very true at the time. We had many discussions about that in webinars and commentaries. How do we know that? Look at the price to earnings ratio, the price of the blended average stock relative to the amount of earnings that it generates and provides. It got, at the beginning of 2022, kind of late 21, early 22, you can see in that box in the middle there, was over 21 times. Not as high as we were back in the bubble of 2000, but too high. One of the reasons why there was a willingness to pay that much more for stocks, look down at the bottom there in that box, 10-year treasury yield, which is a good indicator for kind of broadly where rates were. 1.6% for a 10-year treasury. Look at the number right next to it, 3.9. Okay, what does that do? That takes one part of the buying pool away. It doesn't take them out of stocks. That's an exaggeration. It reduces maybe the willingness of someone to be at maybe 55% stocks if they'd rather be at 50. Some a balance like that, where I want to get back to more of my comfort level. Now I can do that with a 4% treasury yield. Great. Okay. And also what to keep in mind here is the PE ratio has come down, and we're going to show you again on a future slide, you'll see exactly where it is relative to history, but it is at its historical level, its historical average, about 16.5 times earnings. For many, many years, a typical PE ratio, depending on environment, 15 to maybe 19 times. Split the difference, there's where we were, there's where we are again. So the question going forward there, we'll deal with the right-hand side here. We're starting to see some revisions down in earnings estimates. It's a common practice, it's a tale as old as time, that analysts tend to be a little overly optimistic. You can see why a lot of those trend lines, where the year starts versus where it ends. Almost always, there are a few exceptions, but almost always, you're going to see some amount of trend down. In stronger negative years, you'll see a big trend down. This particular year should not see that much of a trend down because we are back to averages. It's kind of a good level set. Now we look forward and see what can stocks do to be able to create and retain create and provide out to stockholders the investment returns that we're looking for via earnings.
Yeah, and on the right-hand side, I'd love to point out that 2023 is still above the 2022 line. 2022 was above where 2021 finished, and that's earnings growth. Earnings growth really matters for stock prices. Let's look under the hood of the market a little bit more. I'm going to start on the right-hand side because I was just talking about earnings growth. So I'll start here on the right-hand side. You can see the blue line is what did earnings do over that year. And in 2022, earnings were positive. That's a great sign for the health of the stock market. You want earnings to be growing. You want companies to continue growing their business and growing their earnings. So what happened? Why were we down so much if earnings were positive? Well, it was all contraction of multiples. And you see that in the black line on the right-hand side, but you also see it on the left-hand side in the mega cap stocks. And this is really 10 widely held. This is kind of a cherry-picked list of stocks of widely held companies that are all mega cap, very big, and very widely owned stocks. And when you add up the losses in just these 10 stocks last year, you have $5 trillion of lost market cap. The total US market is about $40 trillion. So you can see how we can end up at a minus 19% on the S&P, really just being led by a select few of companies. Once you get outside of that mega cap, the losses weren't nearly as bad. And we actually feel that you can find opportunities out there in the stock market by looking past some of the most widely held names and finding them specifically in the value sector. So that's partly maintaining our investment philosophy from 2022 with a bias toward value stocks into the current year, 2023. Let's talk about sentiment and kind of how that can be a contrarian signal as well. This is another kind of bullish sign for stocks. Bryan, how are people feeling about the stock market? What is sentiment right now?
So the that chart on the left is showing us that sentiment literally could not be lower. And this is a description of how that got to be. This is the number of weeks out of 52, right? Every year, excuse me, has 52 weeks. How many weeks within that year do you have average sentiment, and this is via this survey, that is at or above average? Okay, what we saw in the past, even in the worst of markets, in 2008, for example, 16 weeks out of 52, we had above average bullish sentiment, kind of thinking that stocks have upside in that near term sentiment. What do we have in 2022? 0 weeks. We know the world has become a bit more polarized in many different ways, et cetera, et cetera. But how could you be at 0 weeks? That has never happened before, even in markets that were far worse. What it could have been, I can play psychologist for a minute and say it was because both stocks and bonds were down, potentially, but that's never happened before. That sets up well for the going forward because unfortunately, just the way that kind of human emotion and sentiment works, some of the highest levels on this chart are going to be at the worst times. You know, it's the old cliche, you buy things, you buy high and you sell low. That tends to happen. How does that happen? How does that kind of portray itself to people? Why do they do that? Let's look at the right-hand side. This is a stacked chart of annualized returns for the S&P 500 back to 1928. The first thing that I would note here is the average annual return for this time period of the S&P 500 is about 9.5%. There is 1 year in the entire history of this almost 100-year chart where we actually had a return that was right near 9.5%, 2016. You might remember from the first few slides that Eric noted that year, and I gave some description there. Interesting how that worked out. But last year, 2022, you see it in the red box. It says minus 19. Effectively from the high, which was 1 day into the trading year, we were at about a minus 20. So let's say that that was a bear market. What tends to happen in bear markets? Look down below. If you drag the eye down, you almost always have a positive year back up. You can see on the extreme left there, the worst year, annualized year ever was 1931. It was followed by a bad year, but that was a much different time period with a much longer period of pain. What do we tend to see here? The first thing that I would note, and I think Eric touched on it before, but I'd say overall, 3/4 of years, almost exactly 3 out of every 4 years in the stock market are positive. That means though that 1 out of every 4 on average are not. Okay, what do we need to know about what happens next? Go down and look at those green bars. When things are negative, it tends to balance itself out. It might not happen immediately. We're off to a pretty good start. Can that continue? We will see. But this chart would say that the red tends to be followed by pretty sizable green on average.
Yeah, Bryan, actually 8 times in history, we've seen consecutive down years. So it's very rare to have consecutive down years. You can see a couple of them on this chart, 1929 to 1930 to 1931, we're down. The tech bubble, we also saw 2000, 2001, 2002 down. We don't feel that we're in nearly the economic stress that either of those environments represented. That's part of why we're optimistic on the stocks for 2023. Another fact that we shared on our last webinar that I think is relevant. This is the year after a midterm election, and those have historically been positive. We haven't seen really a negative year after a midterm election in over 80 years. So that's been a very good indicator of stock prices. And I think, something that could benefit stocks in the coming year as well. We have a couple more slides to walk you through here. We're going to talk about non-US stocks and then bonds. But when we talked about non-US at the beginning, Bryan, we actually saw outperformance from international holdings last year. Why is that? And can we anticipate that happening again this year?
Sure. Okay. So the reason why I think it could continue, and I personally believe it will continue, is that we're getting multiple pressures being alleviated in that broad world of not us stocks, non-US stocks, all at once. One of those would be that the dollar is no longer holding down other currencies quite as strongly as it has before. Another one would be valuations. Another would be kind of relief of specific events, China, Russia, et cetera. Even if they're not completely alleviated, at least some signals that they're getting better. If you look at the left here, this is only 5 years. So this is not a long-term trend. But even in this 5-year window, you'll see some periods when this line is going up towards the zero. That means that non-US stocks in aggregate are performing better relative to domestic. Okay, we've seen periods where this has tried to happen, and we've had some false starts, maybe call it. They've had some periods where they would rise up, get hit down by specific events, or usually in that time period by the dollar being so much stronger than other currencies. If those lines can continue, and they look at that trend line at the bottom there, this is the longest sustained move we've had in that direction so far. We're in about month 4 or 5 of this already. That would be a positive sign going forward. On the right-hand side, I know there's a lot of numbers and a lot of lines. I will drag our eyes over to the very right-hand side. Look at the light blue diamonds against the purple straight line. The light blue diamonds is the current valuations as of 12/31 for some specific marketplaces. US, Japan on its own, Europe in aggregate, emerging markets as a basket, and China on its own. Okay, the two lines here. Well, first, let me start with the US. I noted before that we are right on our average valuation. This would play that out. Our blue diamond is slapped right in the middle of our purple line. We are at our historical average. The good news is that means we're not overpriced like we were before, overvalued, I should say, like we had seen in some recent periods, but we are right on line. What is below the line? Well, I can look at those other categories and see multiple ones, but in particular, Japan and Europe, each of which are very stable marketplaces, long histories, good companies, and each of them are trading distinctly below not only the values they've had in recent times, but their 25-year averages. Both of those, or all of those factors, would show me that there is some upside opportunity there, and we still like our positioning in that part of the world.
Yeah, thank you, Bryan. And our last slide here, we're going to talk about bonds, which are a large component of a lot of investor portfolios. And yet last year was not like anything we'd ever seen. If you see the US aggregate here, it's about a third of the way up from the bottom. AGG is the ticker symbol there, minus 13% from the Barclays aggregate index last year. Where did that come from? It largely was driven by a sell-off on the long end of the curve. And you can see, 25-year plus zero coupon bonds at minus 41%, 20-plus year treasury bonds at minus 31%. Those are some astronomical losses in the bond market from the long end of the curve. And, we've recommended investors stay shorter than the aggregate index. We're still recommending that today. And the reason for that is on the right-hand side of this chart, you can see that little camel's hump on the yield curve. Right now, there is a lot of yield to be had in that 3-year or less time period. And our view that the Fed will not have the flexibility to lower rates as aggressively as the market is pricing really means to us that camel's hump should be a little wider. And you should be able to maintain those yields maybe another year or two longer than what the market is forecasting. So in our view, keep bond portfolios short, but we do think we're not going to see another year like we had last year. I think that would definitely be catastrophic for the bond market. What we think your expected return for bonds is really what your yield to maturity is for bonds this year. And you can easily find a bond portfolio that yields 4%. And that would be what you might anticipate from a bond portfolio heading into 2023. So we are constructive on bonds. We still think you need to be selective and not necessarily push into those riskier asset classes within bonds. But there's some really nice interest rates to be had, both with bonds and with cash. We've advised clients sitting on cash to review their interest rates and make sure that they're getting a return that looks something like the short end of this yield curve, because money market rates even have reached levels of 4% or plus. That's definitely worthwhile reviewing your cash position and making sure that you're invested into cash yielding instruments. So with that, I just want to thank you for your time today. We're always happy to answer any questions you might have about this presentation, about your portfolio, or about the economy or the markets in general. Please don't hesitate to contact either Bryan or myself directly if you want to ask us a question. And with that, thank you so much for your time today, and thank you for joining us. We'll be doing this again on our quarterly basis to provide an update on what happened in the first quarter. Maybe we'll have a little bit more guidance or clarity on where we're at in the recession conversation, and we can talk a little bit about the debt ceiling debate as well in our next webinar. So thank you very much, and have a great day, everybody.
Thank you, everyone.